our normal listeners, you know that we are all about wedding planning. We will talk all things wedding planning and we will talk it all day long. But the reality is that there is life after wedding planning. There is real life stuff that couples need to address and be educated about. And we're super excited about our guest today, but she's someone pretty special to Kristina, so I am going to let her introduce this person.
That's right, Sharon. Okay, you all are in for a real treat because my mama has come to be a guest on this episode. No, in all honesty, my mom has been doing mortgages and home financing. I'm not going to tell you for how many years because she'll kick me under this table. She's been doing it a long time, and she knows all the ins and outs and everything to bring you some good advice, whether you're looking to purchase your first home or if you already own your home and maybe you would need to refinance or you're going to do it as a couple. She's here to tell us all about it. Okay, Mom, take it away. You got to tell them who you are.
Okay.
All right, go for it.
All right. Hi, I'm Kimmel. Been a loan officer for over 40 years. I work for New Washington State Bank, and it is a very fun job that I enjoy greatly in helping people be able to buy their first home or buy an upgraded home or buying a home maybe they want to take and fix up and make it their own.
And like you said, how many years you've been doing it? I didn't realize it was 40 years.
43.
That means she knows her stuff.
I told you she was going to be a good guest. Now you should be nervous, Sharon, because she knows everything there's to know. In all honesty, though, I used to do mortgages just for a few years, not even beginning close to that many years. But one of the things that I really enjoyed about the process is people are not at all familiar with terminology. They don't understand the process because most of the time people don't take time to explain it to them, to know their options, because there's options out there. And that's one of the things my mom's customers, they're not a number, they're not a file folder to her. They're just like a great friend. She wants to do right by them, whatever that means, getting them the home that they're trying to get into, getting them to the payment they're trying to get to, whatever that is. And that, to me, a lot of people don't do that, especially today. So we're going to cover a lot of topics, and we've got lots of questions. But let's first start with one of the biggest questions I think in people's minds. They don't realize how many different programs or loan types there are out there. So you want to start there?
Sure. So talking about our loan types, everyone seems to be very familiar with what's called conventional mortgages. That's your standard 10, 15, 20, 25, 30-year term. A lot of people hear the word conventional, and back a long, long time ago, the conventional loans, everybody always had to have 20%. So some of the people that's been around for a while still think, oh my gosh, it's 20% down. It's not. You can have as little as 3% down for a conventional loan. Then you got 5%, and then you just keep going. That's one of the loan types. Then you go into your government type of loans, which is VA for veterans, USDA, and FHA. So USDA is all set up by, if you see a home listed for sale and it's going to say USDA financing or 100% financing, that home is in the census tract for USDA, and then there is also a cap on how much money they can make. So that is very specific for USDA qualifications. Then you have the FHA, or let me back up, USDA is 100% financing, FHA is 3.5% down, and VA loans are 100% financing. So the only one that has that census tract and where that property is located is USDA. On the 3% down conventional loan that I mentioned earlier, that has an income cap as well. And rates are great right now, although we've seen a little tick, but we're spoiled with where rates are compared to where they were back in the 80s, that's for sure.
So for people that are listening, some of the things that you just mentioned, do they need to know when they're buying a house which program they're going to fall into?
That seems to be one of the things is sometimes they're afraid to say, I don't know where to start. And I like to go overboard by talking to them, getting their information, asking the questions, not just say, here, go online and fill out the application, I'll get back to you. Well, yeah, you fill out an application and I can do it verbally or we can do it online, however. But getting the right questions by asking, how much are you looking to spend? Maybe like you had stated, they're just looking for a certain payment made, they've been paying rent and that works well for them. And then you get that credit pulled, and that credit, which requires a credit score, then tells me which programs I need to, that they're qualified for, and that's how I start.
Okay, hold on. We've got several questions here. Mike, I think you're gonna go first.
Okay, so a bride and groom, they just got married, and you're talking about their credit score. Does it go on both of them combined, or is it just the male part or the female part?
Ooh.
That's a great question. A lot of people don't realize there are 3 major credit reporting agencies, which is Experian, Equifax, and TransUnion. A lot of people say, why aren't they all the same? So we pull what's called tri-merge credit report because being tri-merge is 3. And when you have a joint applicants, we're gonna pull a tri-merge, which I should get a total of 6 scores. Then you take the middle score of each borrower, and then whoever has the lowest middle score is where we place and start the grid for where the rate falls.
Ooh,
So-
very good explanation, because Mike, that's a good point. Each person's credit bureau is their own, and they have to look at both borrowers. That's a really good question.
So if one partner has a really high credit score and the other partner maybe has a much lower score, it's that lower score.
Yes.
Wow, I never knew that.
And what I do in some instances like this is if the higher credit score person can carry the loan by themselves, we can leave the co-borrower, which doesn't mean man goes first and woman second. You can flip it. So I'm gonna say borrower, co-borrower. I'll say, hey, you wanna drop, we drop the co-borrower here, leave them on the deed, purchase contract, and then we get a better rate for them because we're only using the higher score.
Does that make sense, what she's saying there?
It does, but let me ask you this. If, say myself, I'm 19 years old, me and my bride get married. She has no credit score at all. So is her name still gonna be able to be put on
No,
the loan?
for mortgages, you have to have a credit score. And right now, all across the board, when COVID hit, everything went to a minimum score of 620. So she would have to have a 620 score.
So basically, they would not be eligible to even get a home.
He would be, she would
She
be
would
able
not be.
to be
So
on the loan.
One thing that she mentioned, I don't think maybe our listeners might understand, is she made the comment that the first borrower could carry it. And what she meant by that was the loan could be in just borrower one's name. However, both husband and wife or both the couple themselves could be on the deed. So they both own the home, but the loan responsibility would just be the one borrower. So it's not as if you don't own your home together.
Right.
Sharon, you had a question,
I
right?
do. So Pam is, my boys are grown now, but I remember them being in college and they would talk to me about opening credit cards, and I always said absolutely not. You don't want a credit card. I don't want you to use a credit card. I didn't want them to have any debt, and I thought I was giving good advice, but as I hear you speak, I'm wondering if I did them a disservice, because what do you recommend young people do to build their credit score but still be safe with gaining debt?
Sure. So there are some secured credit cards out there for people that don't have a score. So what you want to do in talking about safe is like they get $1,000 secured credit card. Now the key, and a lot of this information gets told wrong, so I'm going to implement this very big here. The key is you have $1,000 secured credit card. Do not go over a $500 balance. You keep it at 50%. Why? Is because once you go over 50% of what that line amount is, it hurts your score. So you're trying to build it. So go get gas, go get groceries. The other thing that happens is they'll say, okay, get a credit card and then pay it off each month. Wrong. Paying it off, you're not establishing that you're responsible to make a monthly payment on time, consistent. If you charge it and you pay it right back off, that's not going to build that score.
And even sometimes if you don't hit it correct on your billing statement, it doesn't even show. If you made a purchase and the next week you pay it off, it doesn't even go through a billing
Right.
cycle to
Because
show up
it's
on your credit report.
Yeah,
I
it's a
never knew
30-day
that either.
cycle.
That's very interesting. I had
Because
no
I
idea.
always thought if you have to charge something, you pay it off that month. Like you don't want to pay
keep interest from
Yeah.
accruing, which that makes sense. What she's saying is that at that point, you don't see it. But you've got to let that roll. So I'll have ones that go out and I'll just say, okay, don't go over that limit. Keep paying the minimum or maybe pay 100. Then once it starts getting lower, charge some more on it and keep it right in there so that you can watch that to help build that score. Now, does that happen in 2 months? No. It's probably going to take 4 to 6 months for that to kick in.
So one of the things, Sharon, that I want to make sure we make clear, okay, is we are talking about a credit card in order to increase your credit score. Now, if you are using a credit card for points possibly, and you don't want to incur interest, like my mom said, then of course you want to pay it off before it cycles through
But
for
for
30
young
days.
people that are trying to establish credit, I think this is great information. I mean, I sure wish I would have met you back when I was,
Me too.
19 or 20 instead of 52. But
This
I
can also
never knew that.
This can also apply to people out there that are already married that may have lower credit scores for whatever reason.
Life happens. Yeah.
Life happens, but there are tools you can use. But a lot of times people say, "Go get a credit card." They don't finish the sentence. Don't you go over the 50% mark because it's going to hurt you.
Mm-hmm. And a lot of credit cards are hard to get if you don't have a score. So, our bank, New Washington State Bank, has a secured loan that they'll do the same way. Give you $5,000, and then they take that loan that you're getting for $5,000, put it into a CD, and you make payments on it. And once you get that paid back, then they hand you back that
5,000.
That 5,000. But that builds and reports immediately too.
So for people that are listening, because not all of our listeners are local to us, which we're Southern Indiana across from Louisville, Kentucky. New Washington State Bank is a local bank here with several branches. But for those out there that are across the U.S., this would be a question you would ask your credit unions, banks, things like that, because most of them will have some type of program or have someone there to help answer those questions for you.
They should.
We have a lot of parents that listen to us, of kids that are, I say kids because they're my kids' age, but of people that are getting married. So if you have say a college age child, does it help build their credit if maybe, I don't know, they need a car and you co-sign for that car with them? Does that report to my credit or would it report to my child's credit?
Both.
So that does help.
Is co-signed. Yes. Yes. Mm-hmm.
So talking about parents, say that I give my son $20,000 to put down on a house. How does that factor in when it comes to him getting a loan?
Having more of a down payment than like the 3% or no down payment.
I mean, does he have to have record that he had $20,000 in the bank, or I gave him $20,000?
Yes. Yes.
Good question, Mike. Really good question.
Big paper trail of when there's going to be gift funds involved, which there is what's called a gift letter that has to be signed by the donor and the applicant, and then that donor.
So does that mean that I'm giving him a letter that he does not have to pay that back to me?
Yes.
So let's walk our listeners through that. So Mike just gave an example of a father of a couple gives $20,000 towards purchasing a home. So what does he do with that money? Does what if here's $20,000 cash?
No.
Okay, that's what we want to get out there, right?
Yes.
Tell them what they need to do.
So if a family member is going to give their child or say a grandchild money to buy a house, they do need to write it in a check form, and they would deposit that into their account, the child or the grandchild. And then this gift letter would be signed, and then you'd have the paper trail of the check that was written from the donor. The other piece of that puzzle on the paper trail is the donor has to supply a 30-day printout of their bank account to show that that 20,000's been in their account for over 30 days.
Okay, so I'm gonna play the other side of this fence.
That's very involved.
That is.
Well, and a lot of times I think this comes up for people where somebody just, let me ask the question this way. Old school ways. Older people may not have kept as much money in their bank or savings. Some people kept that at home. And I think some of that goes on now. So if a parent, grandparent, or whoever that is going to give money and it's cash, what has to go on? Because it has to be in an account, right?
So the donor then would need to put that money in the bank and then wait the 30 days before the gift is done in order for all that to work as far as the 30-day printout, doing the gift letter and all that.
I always thought if you had the money, you had the money. I never knew they wanted to know where it came from.
And that got in because of the money laundering and everything that went on it. That's regulated what our underwriting guidelines are.
And the reason I wanted her to bring this up, and I'm glad you asked that question, was guess when a lot of times this comes to light? My mom will know better, but can you imagine going out and finding a house and then you're going to do this loan and all of a sudden, well, okay, I'm putting $20,000, where that's going? Oh, well, last week my grandpa gave me $20,000.
Well, you know what? I was just thinking about this. What if they got $10,000 for wedding gifts?
Well,
Now that's different.
Yes, I've had that come up. And of course, if you get into that and you show that you just got married and you deposit probably going to be checks from all these people, and it's probably going to say wedding gift or something, you can usually get that to surpass through the underwriters.
Or there's some of these links, how people can do a honey fund, or there's even like, we're going to be buying a home, help us furnish it, where they would have a printed report to show this money came in there. That's really good. That's a really good
I just
question.
didn't realize that they would go to that extreme to track that and go back and see if those checks were made out for wedding gifts.
Well, when you buy a home, you have to supply 60 days, 2 months bank statements. Those bank statements are read very well by underwriters.
I mean, I haven't bought a home in 30 years, so.
Same.
And
Okay, you bring up a good point. Let's go back to the basics. If someone's going to apply for a loan, what information do they need to compile? Because you need a complete view of their jobs, the money they bring in, their debt, things like that. So what are all things people need to compile when they're going to apply for a loan?
okay, well, let me touch on the 60-day bank statement.
Oh, okay, good.
Because right now, a couple of my clients, I have been advising them about where's your money coming from? What do you have? Do not put any cash deposits in. And they're like, what? And my one customer's like, my husband has a side job he does on the side, and they might pay him cash. Well, leave it alone. Don't be throwing that in there, because trying to explain that and you want to use that money, we're going to go down a road I don't want to go down and try to have to prove
This
those
actually, I'm
things.
going to be really selfish here and ask a question for myself.
Go right ahead.
This happens, I get, owning my own business, a lot, especially younger people now, they want to pay through PayPal or Venmo or something like that, and it's legit money that I earn.
Mhm.
But how would you justify those kind of, like, for people that are self-employed, how do they?
She's opening up a whole nother can of worms with
Well,
self-employed.
and with all those type of payment plans now, that's something we haven't seen a lot of. But being self-employed, what they do require bank statements as well, and you're going back 2 years tax returns, and then you're gonna do a profit and loss. But they're gonna see that the money you're claiming that you make and the money that's coming into that account, those
Match
type
up.
of accounts are gonna be acceptable.
Okay.
It gets a little trickier with self-employed people, just from my knowledge, because you can get into people that have, and this is a little off topic, but you can get into where people are in partnerships with businesses, with people. You're a whole other can of worms. But Sharon, this is a really good point, because there's a lot of people out there that are starting their own business much younger, that are entrepreneurs, that, take for example, a lot of virtual assistants. And, knowing this stuff, if you're self-employed and you know that you're going to be buying a car, a home, or something where you're going to have to show your income, what should they do?
Well, if you're gonna go down the road of being self-employed, or are you already self-employed?
You're self-employed, but in the next few years you're going to buy a home.
We have to have, normally, it's a full 2 years tax returns. So if they come and say, hey, I started this last year, went self-employed, I can't help them on my side of the mortgage
And
world.
that's good information right there, because I
It
feel like
is.
in this generation that is coming up, they're more gearing towards, being
Self-employed.
self-employed.
Mhm.
Or they don't understand about, I'm going to buy a home next year, but I'm going to start my business and quit my job next month, without even thinking to ask any questions ahead of time. Oh, this could keep me from qualifying. I may have to end up waiting another year or two. That's why I wanted to ask her about that.
Now, if we go to what's called really not your standard conventional loans, New Washington Bank has their own portfolio loans. And on
That means?
self-employed, portfolio means it stays in-house with them. And their underwriting guidelines are a little more different. And they can look at somebody that's possibly doesn't have 2 years tax returns and is self-employed and got 20% down.
It's a more one-on-one basis. And I
Yes.
think the point that we're all headed towards here is planning ahead a little bit and asking the questions before you get your heart set on a house or whatever that may be. You need to know what's at stake.
Tell me, I'm going to be the stupid one here and ask the question, because I'm sure there are people that will want to know this. But what's the definition of conventional loans compared to all the other loans that you lifted?
Conventional is just your standard mortgage out there that goes through what they call Fannie or Freddie Mac, and it's not a government loan.
Okay, what's
Who are they?
Fannie and Freddie Mac?
Fannie
Let's
Mae,
keep going.
Fannie Mae and Freddie Mac is who backs the conventional loans on the conventional side.
And by backs, honestly, for our listeners, what does that mean? They're the ones that are,
That's who puts your underwriting guidelines and everything in place for those type of loans.
that's your kind of like your regulators.
Yes,
Of that.
and that's where the underwriting guidelines and all come from.
I saw Sharon's face over here. For those of you that are listening, we put a video of the recording up on our YouTube channel, and Sharon over here, she kind of stepped back and her eyes got big.
I mean, who are they? I don't know who they are.
Yeah,
You don't know
unless
them?
you're in this world, you're like, who's Fannie Mae and who's Freddie Mac? Yeah.
It sounds like a 50s song.
Mhm.
So let's circle back around to, you've got a couple out there. They work regular jobs, meaning they're W-2 employees. If they're going to apply for a mortgage, just so they can start the wheels turning in their mind, what do they need to be prepared to show or to bring as far as documentation goes?
So let's just talk about kind of going down the application part of it. Is the application requires to know where you've lived for the past 2 years. and then where you've worked for the past 2 years. So if you've been on your job for 2 years and you've lived in the same place for 2 years, it's fairly simple. I have some people that have had 10 jobs in the past 2 years. I have to know start and ending dates, address, phone number to all those jobs covering the past 2 years. And
That's probably a big negative though, correct?
no,
It's not?
no,
Well,
I mean,
would-
you wouldn't look at someone that's had a job for 2 years at the same place compared to somebody that has had
used
10
to
jobs
be,
in 2
used to
years.
be.
See, to me, it sounds like it's a negative too, like
Yeah.
they're job hopping, they're not gonna stay anywhere.
No, because in the one instance, I think he had 10 or 11 jobs that I got closed a couple of years ago. But he was in the medical field. And he transferred close to where his kids were. Was there for a while, got something a little better, then he moved where my kids are. And as long as you don't have a gap of employment for more than 30 days, that's not a problem.
So as long as they
That's interesting.
had income coming in.
And it used to be they didn't want to see you really get out of the field you were in, but that's kind of slacked. That's not, as long as you're employed and you can show it. And then when COVID hit last year and you had so many people that were off, you're thinking, oh my gosh.
Yeah.
But as long as we got the verification to show they were off for COVID and had that verified, it was fine.
That's a good
Interesting.
good point. I didn't even think about that. Okay, so we're at your job history.
Job history.
Mhm.
And then knowing what your gross income is, which a lot of people go, okay, which is that? And I'm like, it's always what your amount is before taxes come out. And then,
And that is as a couple.
yeah,
If it's
each
a
one
two
you-
borrowers on it, it's your gross income together.
Yeah, well, you break it down individually, and then you have, okay, where do you have your check accounts, where do you have your savings accounts? Sometimes I will ask if they have like an IRA, 401ks, anything like that. Sometimes we meet it, sometimes we don't. And then, once we pull credit, I can see the liability, so I don't really have to go in and ask every one of their debts. I will
Okay,
have-
for those who don't know what liabilities are, you
Okay.
just said debts, but some people aren't gonna know what that is.
Sure. So on the mortgage, on the loan application, it's gonna say liabilities. Liabilities is credit cards, car loans, mortgage payments. It's what debt, monthly debt you have.
So Franny and Freddie wanna know who you owe.
Yep.
Gotcha.
And we're gonna get to that, Sharon. You can tell how long she's been doing this. You might not realize, or you all might not realize what she's doing. She's visually going down through the application.
Cause she's seen it so many times.
Correct. Yes, so go ahead.
One good point is, they might have just paid the car loan off. Okay, and I'm getting ready to pull credit, and I just paid it off last week. It's not gonna show. So I'll make note of that, and then I'll say, okay, as soon as you get a letter that's showing it's paid, or something like that, hold on to it, send it to me so we can, because when I submit it, I'm gonna show that liability paid off. If I don't have to account for it in the ratio for their income, I don't want to. And then we go through and I'll pull up those liabilities, and then I put it all together, and I'll ask, what are you looking to buy? Some of them will say, I don't know. Tell me how much I can buy. So then
That's what I would say.
you work it, yeah, you work it backwards, and then they might qualify for one amount through FHA, and they might qualify for a lesser amount through conventional, and there's a reason why I can go into that, but each program, they're not gonna qualify for the same loan amount.
So I heard you just say ratio,
Mhm.
and just so I make sure I understand, the ratio between what they have coming in as far as their income and what they owe each month,
Mhm.
correct?
Yes.
It's called debt to income ratio.
Mhm.
She just shortened it.
Yeah.
Yes.
Yes, and a lot of people say, okay, well, my cable bill, my cell phone, my utilities, we don't count those. So it is just liabilities,
Debt.
debts, and if you have child support coming in or going out, that's something we've got to know.
The one thing too is a lot of people don't realize, they think that they can qualify for a house, and my house payment's gonna be $900. Well, the other thing that you have to take in consideration is the taxes and insurance is built in there as well.
Yes, if you're doing a conventional loan and you do 20% down, you don't have to have the taxes and insurance in the payment. But I have to know those amounts for two reasons. One, it still has to be added to the payment to say what your true housing expense is for the month. Second of all, when you're doing a purchase, your homeowner's insurance needs to be collected at closing and paid up front, or we collect it at closing and it's paid up for a year. So those are two items, might be in, might not. Most of the loans, all of them are escrowed with the taxes and insurance, but if you're doing a purchase with 20% down, or if you're doing a refinance on the conventional side and you're in that category of under 80%, then you don't have to escrow those taxes and insurance. But then, when you're over the 20%, and depending on which program, you might have what's called mortgage insurance, or PMI. And back in the day, that was just, oh my gosh, the worst thing in the world. You don't want PMI.
I remember that when I got my house.
Yeah, and now it's a common thing. Conventional does have where it eventually falls off. USDA does not fall off, and FHA doesn't fall off.
Can you explain a little bit what mortgage insurance is? Okay.
And what is PMI?
Stands for private mortgage insurance, or PMI, or they'll call it MIP, or as loan officers just say MI. So it's a mortgage insurance. So
It's like a whole nother language.
yes, yeah. So the reason those are on the loans is it's not an insurance for the borrower. It's an insurance for the lender should the customer default.
And default means not pay their mortgage.
Right. Go very delinquent and all that. Yes, and then that would kick in. So one of the things FHA several years ago had where it was falling off. Now they changed it and went back and it never falls off. So VA is the only product that doesn't have mortgage insurance. It does 100% financing. They, depending on your veteran, if he is disabled and his certificate of called a COE for VA shows that he's exempt from the funding fee, then he doesn't even have the funding fee. It's just straight up 100%.
Wow.
It's a nice program.
Well deserved.
So let me ask you a question on VA. If he or she is a veteran, should they always go VA? Is that always the best option for a person that's a veteran?
I would say a good percentage of it, yes. But then again, if you have a veteran that's putting 20% down, say maybe he's selling his existing home and going in, he's got 20% down and he's not exempt from that fee.
VA offers 0% down, 100% financing. A funding fee is applied if the veteran is not exempt, depending on if it's 0% down, 5% down, or 10% down on what that calculation is. If you've had a prior VA loan, then that VA funding fee is calculated different as well. And that is according to the 2021 VA guide.
He's got 20% down, and that 3.3 could be pretty costly to add on. I might price out the conventional loan just to see. Now, the rate for the VA should be much lower, but I would price it both ways just to check it.
So the reason that I asked this question, just Sharon and Mike, so you all know, is sometimes when you go to speak to someone about their mortgage, they don't know you. They're just gonna do what they can do, get you approved, and that's that. But if you have just a little bit of education, just a little tips to you know where to ask some questions, is that the lowest your payment can be? Do I have to go VA? It could end up, like you said, that money adding up, it could end up saving you money. You don't have to become an expert in the mortgage field, but if you just know a few of these tips, it could end up saving you money.
And another thing to add to that, talking about a veteran and VA and where these debt to income ratios lie. There's a lot of FHA loans out there. FHA allows for a higher debt ratio. Higher debt ratio allows for you to possibly maybe buy a little more expensive home. Or maybe you just got some debt, maybe a car loan you pay $700 a month, go be paid off in 2 years. You really want this house, and you can't get qualified because your ratio is too high on the conventional side, or VA, because they do have a little bit tighter ratio. So I have a lot of people I have to put it on FHA to make it work for them for what they want.
Well, I know you're covering a lot of information, but let's go back to the beginning for just a minute.
Sure.
My brain is just rolling like a wheel.
Or if you're still at the beginning, we're in
well,
trouble.
well, I'm just going back to the beginning just for a second, because if me and my wife, brand new to the, being married, where do we even begin to start? Do we start with you at the bank, or do we hire a realtor? I don't even know what we do first right now.
Well, in the market that we're in currently, and I'd say for the last couple of years, the realtors would really like you to be pre-approved before you contact them. And that's a good thing, because one, you're gonna know about where your max is and where to tell that realtor you're looking. They're gonna know that they really got someone that's taken a minute to get pre-approved, and in their busy time right now, it's crazy, to be able to take time and show people homes so that they know where.
I have a really good friend who's a realtor, and we were just talking the other day, and she said her agency that she works for has quit doing showings for people that are not pre-approved.
I was just getting ready to
Because
mention
of
something.
the waste of time. They don't have time to show you 5 houses, and then you can't get a mortgage anyway.
Yes.
Well, and you can't just say, "Oh yeah, I'm pre-approved." You've had to send. I've
Yeah,
heard
we
you-
have to do a letter. They want to see a letter. Now, there's a few agents, if they would call me and say, hey, so-and-so said you got pre-approved, but they don't have the letter. And if I would say, yes, they are, they'd take my word on it. But I don't blame them. I mean, that's a lot of driving, gas and everything.
Well, and I think right now, with the rates being what they are, I think realtors are so busy because rates are so good that everybody's wanting to buy their house while these rates are so low.
Mhm.
So she was saying they just don't have time.
Right?
So I just pick a bank and go to them, and hopefully they'll help me out.
Mhm.
I mean, I'm really playing stupid here, and say, what do I do first? So
Or you can call me.
So for our listeners, very good. That's exactly for our listeners. Where can they be located for you to work with them?
Anywhere. I'm licensed to do anywhere.
In the United States?
Yes.
Okay. So you may not know, but we're also in other countries, believe it or not.
Oh,
So
I don't know about outside the United
okay,
States.
I'm really trying to clarify because we do have people that listen that aren't in the U.S. Thank you all for tuning in. We appreciate it. However, you can go to a local bank or financial institution and talk to them about your country's specific guidelines
Mhm.
to get the right direction. Because really what we're talking about is U.S. based. I mean, a lot of our listeners are in the U.S., but just for those who might not be, depending on where you're located, the guidelines might be a little
I
different.
think it's changed so much because I remember, I've lived in my house for 33 years. I've had the same house, and I remember getting the realtor, and the realtor showed us houses, and then we went and we applied for the mortgage. The realtor told us where to go. So I'm kind of like Mike. I wouldn't have had a clue where to go to get the mortgage first. That's a different way of thinking.
Well,
for
and
me.
when Pam and I bought our house, we actually built our home. So we did go to a local bank to get a construction loan. So that seemed like it was a little easier, but if we were going to house to look at different places, I wouldn't know to go to the bank first or go to the...
My mom's going to kill me now because you just brought up a great point. With the housing market the way it is, people aren't able to find something that they want, and they are turning to building a home. So for those listeners out there, if they've never owned a home before, can they go into a new construction as their first home?
If they have the credit score, Yes, our bank does construction loans.
Our construction loans, do they require a more qualified buyer?
The score is a little higher for the construction loans. You're looking at a 20% investment. So let's just say you've had this lot, and you didn't know if you were gonna build or what you were gonna do. And you've had it for a couple of years and you're like, hey, I think I wanna build on it. Well, if you've paid for the lot or you have a small balance on it, the equity of the lot and what it's worth now could be used towards that 20% for your construction loan.
Our listeners are gonna have to get out a pen and piece of paper. All you need to do is call Pam Kimmel at the Washington State Bank. And honestly, I know this can be overwhelming, but I really think this is good information. And honestly, for anyone, parents of the couple themselves, it doesn't matter. A lot of this applies. So one of the things that you mentioned is their credit report. And I think it would be good to highlight a credit report. You make a payment today, next week it's not showing on your credit report. For the most of the part, it's 30 days, right? For it to cycle through?
Yes.
Okay, because you mentioned about if you just paid off a car, it could take 30 days or more to show up that it's paid off.
Yeah.
Okay, I just wanted to clarify that.
And just to update you a little more on that is the cycle for the credit agencies, those three that I mentioned, TransUnion, Experian, and Equifax, they run a tape, so to speak, like once a month and report it all out, okay? So you might have paid that car off the day before they send that tape out. So then it's gonna be another 30 days before it reports. Now, as a lender, we do have where we can request verification that it is paid off. In some instances, even though we have the letter that says it's been paid off, underwriting will still make us get that request sometimes.
That's another, I think, big plus for pre-approval, because what if you don't have pre-approval, you find a house you love, and the way today's market is, there's probably 5 other people that are gonna try to buy that house as well. If you have to wait on something like that, it could cost you getting the house you want while you wait for that.
Right.
It's such a good reason for your mortgage person, your loan officer, to have a clear picture of what you have going on, so they can give you credible information on how to maneuver. You need 20 more thousand to be able to buy this house. What can be paid off? What money do you have? There's so many different ways, and I think people don't realize. You go to somebody, you get one answer, you know. And I want to bring up to my mom, this is one of my favorite things. What about you've applied for a mortgage? What's one of the first things you tell people? You've applied for the mortgage, you've ran their credit. What do you tell them? I hope your answer is the same as mine.
What you mean?
What don't you want them to go do?
Take what I've given them and go shop it, you mean?
No, go out and buy a car.
Oh, well,
Or this is
Add additional debt.
Oh
Right.
my god! And you would not believe, or they'll go to a furniture store and take out a $5,000.
Well, I mean, they're getting a new house, they prefer.
Right, but
and that has happened.
this
that
does,
has
but
happened.
this will cost them their. Honestly, they don't know, and this has come up, and that's where it's happened. Is the
Well-
smallest thing can keep you
Because it changes their application.
if you go so long. If I'm right, you can correct me. If I'm not, you may have to pull a new credit bureau before the loan closes. You know.
So you're
before your
saying do
close-
not do that before the loan closes?
Right, if you're serious on looking, and I'll give a couple examples that I had a couple years ago. I had a client moving to this area, and she was just transferring with her job, and right before we closed, the credit report expired, because credit reports are good for
120 days.
and it was going to expire before we went to closing. So we had to pull a new credit report. She had went car shopping, and the dealerships shopped her 21 times.
So like each
Okay.
different dealership ran a credit report.
Yeah, that's what I was gonna say. Shopping, people won't get that, but they pulled a credit 21 times, and guess what that does to your score? You wanna tell them?
It almost cost her her home. It did cost her on the rate because it dropped her in another tier bucket. So, if you are gonna go shop for a car, don't give your social out to every
Dealership.
place that you stop, because a lot
She
of
probably
them-
just didn't know.
She didn't.
Well, and you don't, she may have went to just a couple dealerships, but they shopped her on multiple lenders.
Yeah.
Or sent her information.
When I bought my car, I remember I have, it's probably not near as fancy as what you're used to, but I have Credit Karma on my phone.
Mm-hmm.
And I kept getting these notifications that someone was running my credit. And I'm like, I've sat right here at the Volkswagen dealership. I didn't go anywhere.
That's
But
what
they
happened.
had put it all, to
Because
different
they'll have
lenders.
4 or 5
Yeah.
different dealers.
I wasn't buying a house, but I totally know what you're talking
Yeah,
about.
and people don't realize that.
Yeah.
I mean,
My
you
phone
know,
just kept going ding, ding.
I didn't
Yeah.
realize that.
And what I
Yeah.
was bringing up was about another payment. So if you
Yes.
added a $500 a month payment, your,
Your
debt
to
rate,
income ratio is now.
thank you, because I'm used
Yeah.
to saying debt ratio. Your debt to income ratio may have went right out the window as far as you getting approved, and you're in the final stages of that.
mhm.
So once you've gotten that loan application done, you kind of just need to keep life status quo for quite some time until you're approved.
Let's pause right there for a second. Josh
What
doesn't
y'all
realize the
do?
door is open.
That's all right.
The camera's gonna go flying. Okay, Stacy, we're at a pause right here. Stacy, we're at a pause.
What's going on, Rebel? You can walk
Easy,
by
Hirsch,
me.
easy.
Come here, Hirsch. Hirsch,
Okay.
Come here. Come on, walk by me. Come on. Hey, Rebel.
John, or Mike, that's recording, just so you know. I'm gonna press pause real quick.
My puppy.
You're fine, bud. I know you can't get through. It's okay. Here. Okay, Stacy, give me just a couple minutes.
I wish I had met her when my boys were buying theirs. They both own homes now.
Well, when your one goes to sell and my brother and sister-in-law can buy that one, she can help them.
There's a lot gotta happen before that.
Well,
house is
and your
gonna be
one
for sale.
son, her one is a realtor.
He's a police officer and does real
The
estate
one
on
that
the
lives
side.
in Crystal Springs.
Oh,
No,
really?
no, Indy, sorry.
Oh,
He's in Indy, yeah. Okay. So you're gonna come back, say something like, 'cause
I'm
you
gonna
were,
say like,
you were finishing
fix
your
her up or-
sentence. So say, Pam, one of the things I just thought about, cause I don't know where you were, what your vibe was on the end of that sentence.
I don't either.
So just bring it home. No. All right, here we go.
Pam, that leads me to another question. One of my favorite shows in the whole world is Fixer Upper. Joanna Gaines is like my spirit animal.
Oh, yes.
I love her so much. But what about that couple that maybe can't afford, the super, super nice house right now? So they do buy one that needs some improvements, that has some, things that it needs. How do they go about that?
Well, one of the programs that I've done quite a bit is called the FHA 203K. It's a renovation loan. So it's all done at one time when they buy the house. And so they buy it, we start on it, they get bids on all the construction that they want done. They pick a contractor. They cannot do any of the work themselves, but it can be rolled in with the purchase price. And you're thinking, well, how can that be that you're gonna get that kind of money and we're only paying this? But the appraisal is based on the subject to of all the work that's gonna be done. So they can get the loan, get the money, qualify for all that with contractor.
I would have never
and then
even known that was an
Ah.
option.
And I'm gonna do just a little bit of clarification here on the appraisal. So an appraiser comes out, appraises your home, but it's subject to means he's going,
Got a copy of the contract to see what all's gonna be done.
and then he's gonna value the home based on those improvements being done. That's what subject to
Yes.
is wording. Okay.
Yes, yeah.
Wow.
So along with that, if you say they've been in the house 5 years, and then they've started to,
One improvements,
improve it and put new siding on it or whatever it
room
may be.
addition.
Yeah. So is that a little different than what you're including with the permanent the first
That
one?
same loan could be used, and we could do a refinance and do a room addition or Some people need roofs, they want a pool, they want a new deck, they want to build a garage. That can be used for that and done on a refinance.
So talking about refinancing, tell me a little bit about that. I mean, I don't even know enough about that myself either to refinance.
I know a lot of people are doing it right now.
Yeah.
Well,
So
or
if-
some people don't realize that they can save money by refinancing. They just know they went out and got a loan for their home, they're making their payments, don't even know it's an option.
True.
Very good question, Mike.
There used to be the old rule, if you can't drop your rate by 1%, then don't refinance. And that's not true. Yes, it is nice to be able to drop your rate, but what happens if you have 20 years left and the rate that you can get isn't quite, it's a little lower, but you can drop it down to 15. You're
15
gonna-
years.
Yeah,
15
15 year
years.
term. So now, my rate didn't drop, but I'm able to knock 5 years off. And when I take and multiply that out, because they'll say, oh, is it really worth it? It's a huge, huge difference. Because when we used to do refinances, if you got a lower rate, it was great. Now to get a lower rate and shorten the term, it's huge. Some people, they're still out there on 4.5%, 5%, 6%. I even had one the other day was at 7%. And it's just amazing how much they're gonna save. And, you know, there's no age discrimination, so if you're on a fixed income and you're thinking, oh, I can't get a loan like that, it doesn't matter if you're 80 years old and you come in to apply for a 30-year mortgage.
Interesting.
And if you can knock those years off, you're gonna pay less, right? Because the interest you would have paid those, say, additional 5 years is now not gonna be paid.
Right.
So what is the finance right now?
The
What's
rate?
The rate.
Rates are determined in several categories. One's your credit score, because there's different tiers for that. Another one is depending on your term. So a 30-year term versus a 15, the 15's lower. Another is the loan size of, like, you'd think if you're getting a $50,000 loan versus 100, the rate would be lower on 50. It's not. The more you borrow, the better the rate. So for someone to go, hey, I got this, what's my rate? Purchases are discounted at a lower rate than a refi. So their credit score, if they're putting 20% down or only 15% down, all these different tiers play into that on what a rate's going to be. So
Can you tell a little bit of a starting
Like,
rate
what's kind of
or
the range
anything?
right now?
I would say right now on a refinance on a 30-year, if your score is over 740, I'd say you're around 3%, which is an awesome rate.
Okay, so
Yeah.
let me give a little bit of a disclaimer here. At the time we're recording this, we're at March. So just so everybody knows, and also go ahead and say, rates can change.
Yes, we had 3 changes last Thursday.
They went up or down?
Yes, they went up. And then Friday, they started coming back down. And a lot of people will talk to me and we'll do a pre-approval and we'll talk about the rate. I had one guy just say, oh, when I'm pre-approved, I'm not locked in. I said, no, because you have to have a property address to lock in so that you're putting all this in. And I said, no, I can't just lock you in on a pre-approval. So another thing that happens is when the realtors are in a frenzy right now, and of course, when those rates start tearing up at any time and people are pre-approved at this rate, and then the rates just went up and you know they're out there shopping and trying to keep up with it. Oh my gosh, did it just go up enough that it kicked them out?
That they
So-
can't afford the payment anymore?
Yeah.
Oh my God.
Yeah, so it gets really,
very stressful to me.
really crazy.
I think I'm gonna stay where I am.
Well, but the other thing too is, when you talk about refinance, can they do home improvements then when they refinance?
So there's 2 refinances. Maybe you want to just take your balance and get on a lower term and do that and save money, or maybe you want to do home improvements and you want to get cash out. If you do cash out, there's a little bump on the rate to get cash out, but you can get cash out. Everything's
Based
topped
on the
at-
equity in your home.
Yeah, all the way up to 80% of your home, except VA will go up to 90, I believe,
Of the value of the home.
of the value of the home.
Wow.
And then you pay off the mortgage that you existing have, and then minus closing costs, and then you get the balance left.
So that could be to build a garage, a deck, put a pool
Anything
in.
you want. You don't have to specify. If you just get cash out, you can.
You just
You
say
can do
home
what you
improvements.
You had a lot of people right before when this COVID was hitting, they were doing cash out refinances because they didn't know if something was gonna happen, that everything tightened down, you couldn't
Right.
get to it, and they were doing cash out refis.
I may be giving you a call. I mean, we're really talking about doing
Have
the
you
outside
not
of our house and stuff.
And are you at your original, what you got?
No, we've refinanced
Okay.
once over the last 30 years, but I mean, I still think we're at 6 or 7%.
I'm sitting here thinking I was
Yeah.
really stupid because I
Mom, you
bought-
might not want him to call you though, cause he's self-employed.
I just
Sorry,
remember
Sharon.
when I bought I'm thinking how stupid I was because when I bought my house, it was at 6%, and I just paid it for 20 years. I paid 6%. I didn't know. It
But
was
you're
an
also
option.
talking about the time frame though too. 6% when
Since
you're talking
Back
about.
then was
Well,
the
but
rate.
it's only been paid off 2 years, so I did
Well,
that for a really long
You could
time.
have probably refinanced.
Don't
it
tell her.
off before 2 years ago, but, I mean, you didn't know, so.
I didn't know.
And now
Yeah.
you're using that life lesson and you're gonna go tell everybody, have you refinanced? What's your rate?
I'm calling both my boys on the way home.
Now okay, yes, I understand. But we didn't wanna throw a bunch of information out there to confuse people, but just help you understand there's different scenarios. There's not just one way of doing it. And if you're gonna buy a home or refinance or whatever the case is, talking to somebody before you get your heart set on doing something, whatever that is.
I wish this was the kind of stuff they offered in school when you took a business class.
You mean everyday life stuff?
Everyday life stuff.
We
Like
need so much
People-
more of that right now.
people need to know this kind of stuff.
Shop class, finance class, bookkeeping,
Yeah.
checkbook, scenario, not to
Check,
just
the
checkbook.
generation now doesn't even know what a checkbook is,
Mhm.
really.
Yeah.
Yeah.
Yeah, it is.
This has been
It
so
is.
much good information.
Okay.
Thank you so
Yeah,
much.
thank you.
Okay, so for people that want to contact you or want to reach out with questions, where do you suggest they do that?
Okay, so you can reach me, my office number is 812-256-5462.
Okay, for those of you that are listening, we will always put links for Pam's contact information in the show notes so you can get to it easier, as well as any information that she has that she wants us to share with you all. So thank you all so much for tuning in. I know you all have got more questions, but
This was awesome.
Damn, it was amazing.
we may have to do a part 2.
Well, we
That's
could.
coming about lately. You know that? It really is. Okay, for those that are listening, we would love to hear your feedback. Visit our website, theringthebling.com, and you can either hit the contact button or you can press the microphone and send us a voice message. As always, we'd love for you to connect with us on our social media. You can find us there and catch the video on our YouTube channel. Until next time, keep planning those weddings.
This episode of The Ring, The Bling, and All the Things was brought to you by The Wedding Experts, whose mission is to connect engaged couples easily and efficiently to local wedding experts. Visit theweddingexperts.love to connect with your local wedding vendors, as well as access valuable resources to help you plan all the details for your big day. If you are a wedding professional, there are affordable and effective advertising opportunities available to you by visiting theweddingexperts.love/advertise.